last year gold beat the stock market. Did they tell you that on, Fox Business News or CNBC? No, no. Uh, the last 12 months, end of February last year, and we're almost the end of February this year. Just for example, gold is up 44%. February last year to now. Silver's up 48%, despite its seemingly lagged behavior. You wait until these other factors come into play. Forex volatility, stock market breaks. And by the way, we're already getting breakage in India, which is a bubble. It's broken its structures. Nikkei is dancing on it. We're dancing on it. And when they break, that's going to be a sudden new emotional factor and cause money to move. And that's what will drive gold in a vertical manner.
Over the past week, the gold market has experienced notable fluctuations, influenced by a combination of economic indicators, geopolitical tensions, and investor sentiment. On February 20th, 2025, gold prices reached an all-time high of $2,954 per ounce, driven by escalating geopolitical tensions between the US and Ukraine. However, by February 25th, prices eased to $2,937.39 an ounce as investors engaged in profit-taking amidst ongoing concerns over U.S. tariff policies. As of February 27th, gold further slipped by 0.4% to $2,905.64 an ounce, influenced by a strengthening U.S. dollar and rising Treasury yields. Some influencing factors include heightened geopolitical tension, particularly the strained relations between the U.S. and Ukraine, announcements from President Donald Trump regarding potential tariffs on European imports, and robust demand from investors due to prevailing economic uncertainties. In a recent interview with VRIC Media, veteran financial analysts and market commentators Michael Oliver and Alasdair Macleod point out some of the recent developments in the gold market, highlighting how these developments will positively impact the gold and precious metals market in the short and long term. According to Oliver, who views the market from a more technical standpoint, we are looking at the birth of a new reality for the gold market and the global economy. A new reality where gold no longer takes the back seat, but a more prominent role in investment and the general state of the global economy. For Macleod, the fundamental side of things is just as bullish for gold prices. During the interview, he highlights a critical trend that could signal deeper shifts in the global gold market. Last year alone, 4.912 tons of gold were stood for delivery. This year, that pace is accelerating. Currently, 2,160 tons are projected to be demanded by year's end, even with bullion banks doing everything they can to limit physical withdrawals. The pressure is mounting, and it's exposing cracks in a system that relies heavily on trust and liquidity. As we present clips from the insightful discussion, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos on gold, silver, and the global economy. Thanks for joining us, and enjoy the video.
I think gold is probably and I've been saying this for about 6 months, and so far it's started to happen, but not table banging, acceleration phase, where gold does things that none of these incremental predictions that we hear from the big banks, 3,100, 3,300, nonsense, where it suddenly leaves. And I think one of the key factors in helping it drive north in a dramatic way is simply going to be not the fundamentals that are driving gold, which are always there. It's money, okay? Never forget it. It's reality. Is the flow of money from a broken asset category, especially the U.S. stock market. I should also add the Indian stock market and the Japanese market, because they're also bubbles. When that money starts to flow, it always goes somewhere. It doesn't disappear. Okay, some of it does, but a lot of it goes somewhere. And in the past, it's gone to T-bonds, it's always gone to gold. And when we didn't have gold legal, it went to homestake mining back in the 30s. So I think that's a key factor to watch now, is not gold itself, but the breakage, the beginning breakage of the stock market, where smart money says, hey, I got to find a safer place. And that will help goose gold.
And Alasdair, how are you seeing things when it comes to the stage that we're currently at in this gold bull market?
Well, totally independently of what Michael's saying, I have to rather agree from a fundamental point of view. It's actually a very interesting juncture, because I think the the viewers to this broadcast will be aware that there have been huge, great premiums recently on COMEX futures over spot. And that has drawn in massive tonnages from London, Switzerland, and elsewhere into New York. Now, I think the big question which we need an answer to is, why is it that this has happened? As always, the answer is never one very simple effect or story. It started with the idea that Trump's tariffs were going to make it difficult for gold to go in, therefore get it in ahead of the tariffs, but the tariffs would probably push the price up 10%. Or, I mean, there might have been a little bit of that to begin with, but actually, it's rubbish. The fascinating thing about this is something which nobody, I mean, I've listened to other people. I was even listening to a broadcast by the LBMA, which I think was done about 3 or 4 days ago. And there was absolutely no mention of this factor, and that is the stands to delivery on COMEX. Now, this is something which was never really meant to happen. I mean, the idea of a future, let's say, running out of its natural cycle is that you have to pin the future at that point to the spot value. So the way you do that is you say, okay, you can close your position in 2 possible ways. First way is you take the contra position. In other words, if you bought it, you then sell it and close the position out. The other way, if you have bought it, is you say, right, I want to have the underlying bullion delivered. I mean, the idea is that the futures market is a credit market. It's not a physical market. And it's just a tangential point, if you like. That was always the intention. But the interesting thing is that following the COVID lockdowns, the stands for delivery have mounted and mounted and mounted. And recently, it has accelerated very, very rapidly. And I extracted the figures for you. If you look at last year, 491.2 tons of gold was stood for delivery. If you look at what's happened so far this year, and we've had something like 18 trading sessions, 285.3 tons have stood for delivery. That is 4 times the pace of last year. In other words, this is accelerating. Now, the stands for delivery are quite complex because, you would think stand for delivery, okay, they're going to deliver my gold. No, that's not what happens at all. What happens is they try and refuse to deliver you any gold. First of all, they make it quite complicated for you to go for the stand to delivery. And, if they can lean on you and say, look, if you're going to do this, we'll never deal with you again. It's the sort of thing that they do. A guy called Rafi Faber went through this, and it's fascinating to see the process. He just detailed the whole thing. But the interesting thing is there's a guy who worked for Sprott who tried to take delivery of silver. And this is meant to be a 5-day settlement. It took 9 months for Sprott to get the silver, which they had contractually taken by standing for delivery. 9 months. Every excuse under the sun was thrown at them. And the other thing that happens in all this, and this is what emerged, is that the big bullion banks will say, look, don't worry, we've got your gold. We've got your gold. We'll give you a piece of paper which says we've got it. You don't want to pay storage fees and all the rest of it. We'll let you off that. Look, here's a piece of paper. Look, we've got your gold for you. I mean, it's a load of rubbish. Basically, this is a credit. It's a credit note for physical, which is worth literally the paper it's written off and no more. So okay, we go back to this thing where the pace of stands for delivery has accelerated. The one thing we will note is that with the delays, people, and I think particularly on Globex, in other words, the people who are not in America using the facility of COMEX, sort of out of hours, whatever. Globex is a very big part of the gold contract. I guess that these are probably the people who are standing for delivery. Now, something has scared them to say, come on, we want our stock, for goodness sake, no more excuses. And of course, the pace at which the stands of delivery have been mounting has put the squeeze on the establishment.
Alasdair Macleod identifies deep structural weaknesses in the gold market, particularly the decline in open interest on COMEX despite rising gold prices. Over recent months, open interest has dropped by 75,000 contracts, creating a bear squeeze that forces short sellers to close positions at a loss. This, he argues, has put major bullion banks under significant pressure. However, a more critical issue is the increasing demand for physical gold delivery, which disrupts the traditional paper gold system of cash-settled contracts. Over the past 4 years, nearly 2,000 tons of gold have been demanded for settlement, straining market liquidity. Macleod warns that much of the gold within Western financial systems has likely been leased or rehypothecated, meaning multiple claims exist on the same reserves. As investors shift towards physical ownership, the market's reliance on paper claims is being exposed. This concern has been intensified by Scott Bessent's proposal to create a sovereign wealth fund backed by U.S. Treasury gold, which has raised doubts about the true availability of U.S. gold reserves, officially listed at 8,132 tons. While no direct proof of missing gold exists, Macleod argues that circumstantial evidence suggests a shortfall. This uncertainty is particularly alarming for foreign investors holding gold in US and UK vaults. Macleod suggests that in a financial crisis, these reserves could face confiscation or forced repatriation to cover domestic shortages. As a result, many investors are withdrawing their gold before potential restrictions take effect, signaling a broader shift towards securing physical assets over paper claims.
One thing I've noticed in many bull markets, and in this case, Alasdair's right, it's not a bull market in gold, it's a bear market in paper assets, okay? That everything is not always a pace, an even pace from low to high. In fact, this was true in 1979, as gold had been going up for 3 years or so and suddenly went vertical. Silver went off the page vertical. The same thing in 2010 and 11. They've been going up for a decade and suddenly they launched, okay? This time we have factors, as Alasdair's pointed out, that are far bigger, more dangerous, more collision-oriented than any others we've ever seen before in modern times. This is a crisis period. Philosophically, I've always said, we're entering part 3 of Atlas Shrugged, where shit hits the fan, okay? And I think some of the things Alasdair pointed out are, in fact, underneath the surface and will emerge and suddenly become clear. But it's always late in the game that then suddenly this awareness dawns, and that's when you get dramatic movements in markets, where gold doesn't go up a couple $100 a month, it goes up a couple thousand in 3-month period, and suddenly launches. But it's coincident with other factors doing the opposite. He mentioned the dollar, for example, a dollar index, which is a silly method of measuring the US dollar versus other paper stuff. Specifically, about 70% of the dollar index is merely the euro and the yen. When you look at the dollar index, you're really looking at upside down euro, upside down yen. Okay, but our technical work there shows that this factor in global markets has been dead and quiet for 2 years. In fact, if you look at the dollar index, it has been oscillating between basically 100 and 110 for 2 years now. So let's take it in the middle, 105. So it's really been in a very narrow, non-volatile, non-trending range. And so it hasn't been a factor in upsetting things or driving things. Gold didn't care whether the dollar was breaking down. Gold left the page. In fact, since 2015, the dollar index was 97. It's now 107. So it's up 10 or so percent. Gold's up, double and a half. So it didn't care about the dollar. But when the dollar comes into play and breaks down, as I see the technicals shaping up right now, we recently got up to 110, well above 110. Now all of a sudden we're trading in the 106s. You get down on the low 104s, and our technical work says you've broken a 30-year uptrend line on momentum, not on price. You'll likely collapse the dollar down at least to 80, if not test the lows at 70. So there could be a sudden volatile activity by the Forex markets that suddenly jar things in a way that they haven't for 2 years. So it's a seemingly outside factor, but it's an underlying major factor. And I think it's going to happen. The technicals look too ripe. The other one is when the stock market breaks. That's the only thing that makes the public smile right now. It's not the consumer price level. It's not anything really good, except their retirement account was up 20% last year. Oh boy. Well, if when markets top, quite often they'll shed 20% pretty quickly. I don't mean you have to crash 35% in 2 weeks, but we could easily see that kind of drop. And when you get that, all of a sudden there's nothing else on the horizon that makes people feel happy. That's when emotion comes into play. Right now, emotion has been placated because if you look at the S&P or the Nasdaq for the last 4 months, it's been like nothing has been happening except it's a gradual, tiny little rise. You could have 2 bad days and wipe out 4 months. When that happens, suddenly you have another emotional factor enter the markets. That's when I think gold as the place to be becomes reality again to most investors. Right now, it's not. Last year, gold beat the stock market. Did they tell you that on Fox Business News or CNBC? No, no. The last 12 months, end of February last year, and we're almost the end of February this year. Just for example, gold is up 44%. February last year to now. Silver's up 48%, despite its seemingly lagged behavior. You wait until these other factors come into play. Forex volatility, stock market breaks. And by the way, we're already getting breakage in India, which is a bubble. It's broken its structures. Nikkei is dancing on it. We're dancing on it. And when they break, that's going to be a sudden new emotional factor and cause money to move. And that's what will drive gold in a vertical manner. Headlines or not. The headlines will come in after the fact. And you're right, the $3,000 level just might be the level at which once you exceed it, the public says, hey, I'm missing this. How come? And we think the real place to be for this year is not going to be gold, but it's going to be silver and the gold and silver miners. We think on a percentage basis, they're going to beat the pants off gold, which is typical late in a bull trend. And by the way, this bull trend, when it, quote, ends, I don't think you're going to have a bear in gold. I think you'll have a new reality globally as far as gold is concerned.
Ultimately, Macleod believes that gold is not merely rising in price. It is serving as a barometer for the growing instability of the global financial system. He emphasizes that what we are witnessing is not simply a surge in gold demand, but a broader shift in how investors and institutions perceive money itself. Central banks, particularly in Asia, have already begun adjusting their reserves, recognizing that the issue is not just gold going up, but fiat currencies losing value. Macleod argues that we are approaching a critical inflection point. The COMEX system is under strain as short sellers are forced out. The demand for physical gold is rising, exposing weaknesses in paper gold markets. Geopolitical instability is making foreign investors nervous about leaving assets in Western vaults. A potential dollar devaluation under Trump could accelerate the move toward gold as a hedge. He warns that if institutional investors, who currently have less than 1% exposure to gold, begin shifting their portfolios in response, we could see an even greater surge in prices. More importantly, this shift could mark the beginning of a broader rejection of fiat currency stability itself. Michael Oliver expands on this by emphasizing how gold's recent performance is not an isolated phenomenon, but part of a larger bear market in paper assets. The dollar, once a stabilizing force, is showing signs of a potential breakdown, which could trigger extreme volatility in global Forex markets. Additionally, a weakening stock market threatens to remove the last pillar of investor optimism, setting the stage for a massive psychological shift toward gold and silver. Historically, such turning points have resulted in rapid price accelerations, where gold and silver enter parabolic moves, leaving mainstream investors scrambling to catch up. This transition is not just about gold as an investment. It marks a profound transformation in global monetary policy. As trust in paper assets erodes and financial instability deepens, gold is re-emerging as real money, not merely a speculative vehicle. With the potential for record-breaking price surges, the question is no longer if gold and silver will outperform, but when mainstream investors will wake up to this reality. Please share your thoughts on Oliver's and Macleod's analysis in the comments section below. If you liked this video and want more like this, please check out our other videos on the precious metals market and the overall global economy. To help us reach more viewers, please share and like this video, subscribe to the channel, and turn on the notifications bell. We appreciate the support and hope to see you in the next one.